Okay, this is Chapter 7 pre-class lecture on fraud, internal control, and cash. After studying this chapter, you should be able to do all of the following. You should be able to define fraud and internal control. You should be able to identify the principles of internal control activities. You should be able to explain the reporting of cash, discuss the basic principles of cash management, and identify the primary elements of a cash budget. Okay, so the very first thing I want to do is I want to define fraud. Fraud, most of us use the term fraud pretty loosely in our everyday life, or I hope you don't encounter fraud in everyday life, but we basically know what fraud means. In the accounting and business world, we have a little tighter definition of fraud. It's defined as a dishonest act by an employee that results in personal benefit to the employee at the cost of the employer. And so you'll see this triangle right here that shows 3 factors that contribute to fraudulent activities. This is very well known in the accounting and business community, and it's called the fraud triangle. And there are 3 points on the fraud triangle, that being opportunity, financial pressure, and rationalization. And if you think about it, let's use some sort of fraudulent example. Let's pretend an employee decides that they want to, let's use one that I know has happened before. An employee decides that they want to set up a fake vendor and charge fake expenses to the company, and then have the company write checks to this fake vendor, which is actually them, and then they can go cash the checks and take that money for themselves. So if you are an employee that works in the accounting department and you have the ability to write checks and review invoices and input that information into the accounting records, you have met one point on the fraud triangle. You've met the opportunity. You've got the opportunity to be fraudulent because you can set up this fake vendor and write checks to yourself and then later on cash them. So you've got the opportunity. The next point is, do you have any financial pressure? Well, of course, you've got financial pressure. Perhaps you are an employee and you don't think you are paid enough and you need to make your car payment and you need to make your house payment, your mortgage payment. And you know what? You really want a boat and you've always really wanted a boat, but you don't quite have the means to be able to do it. But if you set up these fake vendors and paid yourself and made a little bit of money on the side from this fraudulent transaction, you'd have the ability to be able to buy that boat, and you really want it because you really want to impress people. So you've got financial pressure. So you've got the opportunity, you've got the financial pressure. The last point in the fraud triangle that contributes to fraudulent activity is called rationalization. And so if you're an employee that's in this situation, probably you'd try to rationalize your behavior and you'd say, you know what, I don't think I'm being paid enough anyway. I work really hard because I open the invoices, I deposit all the checks, I write all the checks, I send out all the payments, and I'm very underappreciated. And so you can rationalize it to yourself and say, you know what, I earned this or I am owed this. And so this is a very common way of thinking that employees use when they are committing fraud against their employer. Okay, so we talked a little bit about fraud. I need to talk about the rules against fraud, and those come into play when we talk about the Sarbanes-Oxley Act. The Sarbanes-Oxley Act is a piece of legislation that was signed into law in about 2002, and it applies to publicly traded corporations. And basically it came as a result of lots and lots of financial accounting scandals and financial accounting fraud that occurred around that time, around the 2002. It requires companies to maintain a system of strong internal controls. It requires that corporate executives and the boards of directors to ensure that these controls are both reliable and effective. not only does it put certain stipulations on corporate executives like the CFO and CEO and the board of directors, but it also says that independent outside auditors like PricewaterhouseCoopers or Deloitte must attest to the adequacy of the internal control system. So it has to say that, you know what, these companies need a good internal control system to make sure that that we are trying to catch fraud within the company, and the independent auditors now have to attest to that. The Sarbanes-Oxley Act, or SOX, also created an entity called the Public Company Accounting Oversight Board, or the PCAOB. And what the PCAOB does is it basically audits the auditors. So before, if you were Coca-Cola Company, you got audited by Ernst & Young, and they made sure that all of your financial records were okay. And now Ernst & Young also attests that the internal control system is adequate and working properly. One other level of review, now the PCAOB comes in and they audit the auditors. So they audit the work that was performed by Ernst & Young on Coca-Cola to make sure that, that they did it properly. And so you and I, as potential investors in Coca-Cola, will have a little bit better ease about the fact that Coca-Cola's financial statements are properly created and properly represented. Okay, so we've talked a little bit about fraud, and we've talked a little bit about the Sarbanes-Oxley Act. Now we need to talk a little bit about internal control. So what do companies do to try to detect fraud and minimize fraud? Well, they try to put in a strong internal control system to minimize fraud and fraudulent activities. And so there are different methods and measures that minimize fraud, and these are adopted to safeguard assets, to protect assets, to enhance the accuracy and the reliability of accounting records. They are also adopted to increase the efficiency of operations to make sure things are running smoothly, and to ensure compliance with any laws or regulations that they have to adhere to. And so in order to safeguard these assets and enhance the reliability of accounting records and ensure that we are in compliance with the laws and regulations, there are 5 primary components of a good internal control system, and they are listed here. The first is a good control environment. The next is a risk assessment, effective risk assessment. The next is to have good control activities in place. The next one, the fourth, is to have nice information and communication. And then the fifth is to continually monitor. And establishing the responsibility often requires limiting access only to authorized personnel and then identifying those personnel. And so the picture that you see right here is of a cash register. And it says, "It's your shift now. I'm turning in my cash drawer and heading home." And so a good example of an establishment of responsibility is when there's only one person that is responsible for that one cash drawer. So think about if any of you have ever worked in an environment that uses cash drawers. Most of the time, cash drawers are there's a one-on-one relationship between a cash drawer and an employee. Because if you think about what might happen is if you are an employee at Target, let's say, these look like Target employees, and you are giving change all day long, and then at the end of your shift you take your cash drawer back to the manager and they balance it all out. Well, if you are $1,000 short on your cash drawer, they know that it must be something that you did, whether by accident, by giving too much change out, or on purpose because you're committing fraud and trying to steal from the company. They know it's all because of you, because you were the only person in that drawer. On the flip side, if multiple people were allowed to get into that cash drawer and it was $1,000 short at the end of the night, you wouldn't know who it was. So this principle of establishment of responsibility says that only one person is responsible for any particular given task, like responsible for one cash drawer. The next principle of internal control activities is segregation of duties. And what basically this is, or what this states, is that different individuals should be responsible for related activities. So the responsibility for record keeping for an asset should be separate from the physical custody of that asset. So there is a segregation of duties between who actually maintains the cash, like a cashier, and who actually maintains the financial records of that cash. So at the end of the night, in the slide before that, when we were talking about the cash drawer, perhaps you walk back to your manager or you walk back to a cashier to balance your cash register at the end of the night. That cashier takes all of the cash and zeroes out your cash drawer and takes all of that cash and maintains that cash to then take to the bank at some point to deposit it. Well, there's somebody else who is probably responsible for recording that increase in cash, the money that was made from that cash drawer, into the financial statements. So this internal control activities says that you need to have those duties separated. Because think about it, if the cashier is the one who was responsible for depositing that cash, and they were also responsible for recording that cash into the books, what's to keep them from putting a little bit of money into their pocket and not depositing all the money, and also not recording all the money in the books? So a good internal control activity is this segregation of duties. Another principle of internal control activities is documentation procedures. And basically all this says is that companies should use pre-numbered documents, and all documents should be accounted for. So employees should promptly forward source documents for accounting entries to the accounting department. So if you've got invoices that you are invoicing your customers for this video store, Chelsea Video, you need to use pre-numbered invoices. And so all of the documents can be accounted for, and you know which invoices are still outstanding, which ones you're waiting on, how early in the number sequence they are, so how long you have been waiting on them. So documentation procedures is a good internal control activity, so you've got control over those source documents. Another principle of internal control activities includes physical controls. And this is fairly self-explanatory. You've seen lots of this as you are shopping out and about in retail stores. Physical controls means that you are maintaining your physical assets in a manner that is proper and that ensures the minimization of fraud. So there are, in a retail store, there might be television monitors and garment sensors to deter theft. You might have safes, vaults, and security deposit boxes for cash and for important business papers. There would be time clocks for recording time worked of employees. If you've got warehouses, they would be locked, and storage cabinets for inventories and records. If you've got computer facilities, you'd use passkey access or fingerprint or eyeball scans perhaps. And then there might be alarms to prevent any break-ins. And these are all examples of strong physical controls. Another principle of internal control activities is independent internal verification. This is a little bit different than the others. This is basically somebody that oversees or provides an independent verification on the activities that you are undertaking. So the records are periodically verified by an employee who is independent. So we talked about this idea of segregation of duties where a cashier would maintain the cash on hand and an accounting employee would maintain the financial records for the cash in the books. Well, there may also be an independent internal verification that's done by perhaps a treasurer, an assistant treasurer. And what they would do is they would make monthly comparisons and report any uncollectible differences to the treasurer. So if the cashier's amounts don't agree with the accounting department's amounts, obviously that means there's some sort of discrepancy, and they need to investigate why is there more or less cash on hand than is actually reported in the financial statements. So the independent internal verification helps provide an additional level of internal control for a company. and any discrepancies would be reported to management. And then the last principle of internal control activities is human resource controls. And this deals with the human nature of things. One thing that companies should do is they should bond employees who handle cash. And basically what it means to bond an employee is that you need to get insurance on them. If they're going to be handling your cash and walking down to the bank to deposit all your money, you need to make sure that they are insured and you have provided protection against potentially that employee running off with all of that cash. So bonding employees is basically like insuring yourself against employee mishandling of cash. You'd also, a good human resource control would be to rotate employees' duties and also to require vacations. And it sounds funny to say that you would require vacations of your employees. But if you think about it, if you were working in a company and you have been doing some fraudulent things, well, you don't want to take a vacation because that means somebody might fill in for you. And if someone fills in for you, things will look a little off. And this guy in the slide says, if I take a vacation, they'll know that I've been stealing. And so oftentimes a good internal control is not only to rotate the employee's duties, but also to require vacations. And then obviously to conduct background checks on your employees. So we've talked about all of these principles of good internal controls and how we can try to minimize fraud by increasing our internal control presence within a company. But there's also limitations of internal controls. Obviously, the costs should not exceed the benefits. You could put 1,000 monitors in your warehouse or 1,000 cameras in your warehouse, but it probably wouldn't be cost efficient because the cost of 1,000 cameras wouldn't outweigh the benefit of having 1,000 cameras in your warehouse. There's always going to be a human element, so there's always going to be humans who may even collude to override some of these controls, and so you need to be wary of that. And then the size of the business often affects the limitations of a good internal control system. Okay, a couple more things that I want to talk about in this chapter is regarding cash. And so when we talk about cash, we talk about cash on our financial statements. When we record cash, we record it on our balance sheet. And oftentimes you'll see the line called not just cash with a line item or with an amount next to it. You'll see something called cash and cash equivalents. So let's talk about what cash equivalents are. Cash equivalents are short-term, highly liquid investments that are both readily convertible to known amounts of cash, and they're so near maturity that their market value is relatively insensitive to changes in interest rates. So basically they are very, very, very short term. They're very liquid investments, and so they're not exactly cash. They're not green dollar bills, but they're really, really close to being cash and converted to cash. There's also an idea of restricted cash. And what restricted cash is it's cash, so it's green dollar bills, but it's cash that's not available for general use, but rather is restricted for a special purpose. Oftentimes, companies might have to put aside cash for special uses to be able to pay back a debt, and so that's considered restricted cash. And you can see Delta Airlines financial statements from 2011. This is their balance sheet, and you can see their current assets section has cash and cash equivalents, and they also have some restricted cash that has been set aside to repay certain debts. The last learning objective that I want to cover briefly in this pre-lecture is the idea of managing and monitoring cash. So we've talked about fraud, we've talked about internal controls, we've talked about cash and what cash is. Companies need to employ sound principles to manage their cash and manage cash effectively. So you and we may have some cash sitting around, but we don't want to have too much cash sitting around. We don't want to have idle cash sitting around because we need to ensure that we are making the most of the cash that we have. And so oftentimes we need to make sure we are employing the best and most effective cash management principles with respect to the cash that we have. So first of all, I just want to point out the operating cycle of a merchandising company. So you've got cash, and what you do with cash is you buy inventory, okay? And when you've got inventory, you then in turn sell the inventory. That inventory is not immediately paid for, but is an outstanding account receivable from your customer that in turn turns into cash, and you receive cash. And this cycle continues on. But when we talk about managing cash, we talk about a few different things that we can use to effectively manage our cash. And companies employ this, and we should employ this as well. The first thing is you can increase the speed of receivables collection. Well, in the slide before, you saw kind of the life cycle of cash. Most of the time you sell inventory as a company, and then you wait on your companies to pay for it. So it's outstanding as an account receivable for you for a little while until you receive the cash from your customer. And so there's a lag in that time period. Well, if you try to speed up the collection of your receivables, you'll get cash quicker. And so what some companies do is they try to speed up the receivables collection in order to receive cash faster. And so that's a cash management principle. Another tactic is to keep inventory low, because the lower you keep inventory, the more cash you have on hand. Inventory requires cash to pay for more inventory. So if you increase the inventory levels in your warehouse, you're paying for it with cash. So the more inventory you have, generally the less cash you have. But if you are trying to manage your cash effectively, you try to keep inventories pretty low so that you have a higher level of cash. Another cash management principle is to monitor the payment of your liabilities. Some companies try to do this. So if you are buying things from your vendors and they are invoicing you and they say, hey, pay us the amount you owe us in 30 days. Well, if you pay for the amounts that you owe them on day one, then you don't have the cash for those 30 days. But if you hold on and wait and pay them at the end of the payment period, you've been able to use that cash for the last 30 days because you've been able to hold on to it for the last 30 days. So what some companies do is they kind of try to wait until it's closer to the due date in order to pay their liabilities. Other companies plan the timing of major expenditures. You might want to build a factory in a period when you are receiving lots of cash. Obviously, if you're building a factory, you need lots of cash, and so you want to wait until a time period when your company is earning lots of cash. And then the very last cash management principle is to invest any idle cash. So if you've got lots and lots and lots of cash sitting in your cash accounts or sitting in your checking accounts, you don't want to have it just sitting around and not really earning much by way of interest. And so you might invest in short-term investments or longer-term investments so that you're making money on your money. And the very last way that companies manage and monitor their cash is by building a cash budget and keeping an eye on their cash budget. And so this is an example of a cash budget that Hayes Company has put together for the year ended December 31st, 2014. And basically what it does is it shows you all of the cash that they think they're going to receive and all of the cash that they think they're going to have to pay out, their cash disbursements. And it gives them an idea of any excess of available cash over their disbursements or any deficiency of cash over their disbursements. And so they can use this cash budget as just kind of a prediction as to how they think how the cash flows will be in the future. So a cash budget shows anticipated cash flows, usually over a 1 to 2 year period, and it just contributes to more effective cash management. So this is the Chapter 7 pre-class lecture. We'll continue the lecture in class.